Hello, today we are going to talk about lease financing. When there is a lease transaction, there are usually two parties involved. One is the lessor uh, that owns the asset and receives the rental payments or the lease payments, and the second is the lessee that uses the assets and makes the lease or the rental payments. Now, if you remember our discussion when we were talking about the weighted average cost of capital, a lease is very similar to a debt because it has contractual payments. If the contractual payments are not met, the lessor can actually do the same proceedings like when you default on your debt payments. There are four different types of leases. There's operating lease, which is a short term and usually it's cancelable, as well as usually these short term leases have maintenance included, which means that the person that you're getting the asset from is still going to maintain the asset because it's for a short period of time. Then there are more longer term leases, which are called finance leases, and usually these are non cancelable, and the maintenance is also not included. And then there are combination leases and sale and leasebacks. Now, for tax purposes, leases can be tax-oriented lease or a non-tax oriented lease. For a non-tax oriented lease, the lessee is treated as the owner, and for a tax-oriented lease, the lessor, the person that owns the asset, is treated as the owner, and the entire lease payment uh, that the lessee makes is deductible for tax purposes. So, in a tax-oriented lease, the lease payments that are made by any company, they are basically treated the same way as interest payments would be treated. So there is that tax benefit uh, or the tax shield that you get from using debt. You get a similar benefit by using a lease. Um, how does lease affects a firm's balance sheet? For all accounting purposes, lease are classified as either capital or operating. Capital leases and operating leases longer than a year but must be shown directly on the lessee's balance sheet by capitalizing the lease. Capitalizing the lease essentially means you calculate the present value of all the payments that need to be made at the cost of debt. So when you're calculating the present value, you use the cost of debt as the discount rate. Uh, and this value is reported as a lease liability. So it is going to be very similar to like you would report any type of debt, because this at the end of the day is an obligation that needs to be met. So leasing is a substitute for debt. If you analyze any company, and the company is, let's say, using a lot of leases instead of borrowing the money or owning the asset, then you should be very careful that you adjust that the lease amount or the uh, present value of the lease amount or the capitalized lease amount is actually counted for in the debt structure of the company. Because if you don't do so, then basically, if you're comparing two companies, one that uses leases and does not own the assets versus another company that owns the asset and in order to own the asset borrows money, you will never be comparing apples to apples, right? So Uh, in this example here, assume that a firm has a 50-50 target capital structure. Half of its assets are leased. How should the remaining assets be financed? Because lease is a form of debt, the remaining assets should be financed via equity. Uh, so whenever you have the option of choosing between a lease or between owning the asset and borrowing money to own the asset, uh, basically what you do is you run an analysis which is very similar to a net present value analysis like we did uh, in chapters 11. So here let's consider an example. There is this company called Lewis Securities, and they have two options. One is that they can either lease the equipment or they can own the equipment. So here's the example. If the equipment is leased, the firm could obtain a 4-year lease which includes maintenance. The lease meets the IRS guidelines for to expense lease payments, basically meaning that the lease payments that the lessee is going to make are going to be, uh, reducing the overall expenses and thereby providing a tax benefit. The rental payment would be 260,000 at the beginning of each year. So this is the amount that this company needs to make to pay every year. The cost of the equipment is $1 million, right? And if they were to buy this equipment, they would have to pay $1 million. And the interest rate, if they were to buy such an equipment, would be around 10%. Let's assume that the marginal tax rate is 25%. And if they are going to depreciate the equipment over its useful life, then they can use the 3-year depreciation schedule. So if the company borrows and buys the equipment, the 4-year maintenance contract costs around $20,000 at the beginning of each year. And at the end of year 4, they can sell the equipment out for around $200,000 because in 4 years the equipment would have become older, and this is the amount of money that you can salvage from selling the equipment. So now that we have all this information, we can compare which of those two options is going to be better for this company. Should it, borrow the money at 10% rate and buy the equipment out for $1 million and, maintain it on its own, or should it uh, get a lease where the maintenance is also being taken care of? So here's the first thing that we will need to calculate. First thing that we calculate is what is the depreciation going to be on the asset. So in year 1, because it's a MARCS depreciation schedule, which is an accelerated depreciation schedule in the first year. And if you need to find out what these percentages are, you can just Google MACRS depreciation, and you get these schedules easily available. So we need a 3-year MACRS depreciation schedule, and here are these percentages. So in year 1, 33.33% of the property is depreciated. In year 2, 44.45% is depreciated, and in the third year, 14.81% is depreciated. So if you add all of this up, it adds up to 100%. So this is how the MACRS depreciation percentages are calculated. So in the first year, given that on the $1 million equipment, we are going to have a depreciation of $333,300. The benefit because of this depreciation, remember what happens to depreciation is that whenever we have depreciation, then we don't have to, it's a non-cash expense, but it's still shown as an expense. So it reduces our overall tax liability. And given the marginal tax rate is 25%, we basically save $83,325 on not having to pay this depreciation amount. So here is, what happens if we basically own the asset and we take out a loan, right? So this is what happens. Because you are going to take out a loan, you have to make loan payments, right? So given that the interest rate is 10%, so on the loan that you are borrowing, you're going to have to pay 10% interest. Now the number that you see here is, you would have expected on $1 million, you should pay $100,000 in interest every period, right? But here the number is only 75,000. The reason why it's 75,000 is because again we have the interest expenses that we have, we do not have to pay taxes on that. So this amount is basically the after tax amount, right? So the benefits that you get from not having to pay taxes on your interest expenses, you've taken that into account, and after adjusting that, this is your net interest payment, right? So this interest payment is going to be 75,000 every year for the next 4 years. And then at the end of the fourth year, you also have to pay your principal back, which is $1 million, right? So you're adding your $1 million and $75,000 for your fourth payment. Now, the depreciation shield is calculated based on the MACRS schedule, right? So the first one comes from this here, 33.33% times 0.25%. The next number uh, comes from, remember, it's 44.45%. So if we were to calculate this, 44.45. Actually, you know what? Let me open an Excel. So the first one we got 33.33%. Then was 44.45%. Right? So we are trying to calculate the depreciation shield. The depreciation shield was this multiplied by the cost of our asset, which was $1 million. So 123, 123, right? So 33,300. Similarly, for the second one, we also, and the depreciation shield or the reduction in taxes because of depreciation is going to be this number, which is our depreciation amount times our tax rate, which is 0.25%, which is 25%. So we multiply by 0.25, right? This was the depreciation shield for the first year, and the depreciation shield for the second year is going to be this number, $111,125, right? So if we go back to the slideshow, this is how you get the depreciation advantage, right? So the depreciation shield is 111,125, and similarly for the third year also we can get the value of the depreciation shield. Now, every year at the beginning of the year we have to pay maintenance of $20,000, right? So this is why you have this negative 20 number here. And because this is an expense, you're going to also have you will be able to expense that, and because of that you'll also be able to reduce your overall taxes. So this is the tax saving which comes from using this maintenance contract, and you save 25% of $20,000 is 5,000. So every year whenever you're paying for maintenance, you're saving overall taxes, right? And you're getting this $5,000 every period. Then finally, in the end of year 4, there's going to be a residual or salvage value for your equipment, which is $200,000. So you can add the $200,000 back. And whenever you are going to sell this equipment, you have to pay taxes on that, right? And again, given your marginal tax rate is 25%, on the sale of $200,000, you have to pay $50,000 in tax, right? So once you add all of these up, you have your net cash flows when you're trying to own this piece of equipment, right? Uh, so these are your cash flows, right? And once you have all your cash flows, you can calculate the present value of these cash flows.
So the discount rate that we are going to use to calculate the present value of these cash flows is going to be essentially your after-tax cost of debt, because like we've discussed before, your leases are very similar to your uh, debt, right? So for this company, the firm's cost of debt we know is 10%, and given that the tax rate or the marginal tax rate that the company has is 25%, the after-tax cost of debt is 7.5%. Once we have the cash flows, then we are going to basically use these cash flows and use the 7.5% as a discount rate and calculate the present value of these cash flows. Now, when I calculated the present value of these cash flows, I'm getting a different number, and I'm pretty sure that the textbook is or the slides are probably slightly wrong. So if you try and do this exercise on your own, you should get cash flows of a negative 711 thousand and three uh, $93,000, right? So this is what you will get instead of the negative 724. Now, so if we own the asset, right, uh, and if we borrow the money to buy the asset, then this is how much our overall cost over the 4 years is going to be. Now, what we can do alternatively is instead of owning the asset, we can lease the asset. So basically, what we are doing is we are trying to compare between the two alternatives. Now, if we lease the equipment, then what will happen is that every period we are going to have to make the lease payments. So these are our lease payments, right? The lease payments go out at the beginning of the year, and hence, at time zero, we are making this lease payment. So 260,000 goes out every period. Now, because this is an expense, we will get some benefits on making these payments. So we'll get the tax benefit. So 65,000 basically comes from 25% of 260,000, right? So 25% is our marginal tax rate, and we don't have to pay taxes on this $260,000 worth of our lease expenses, right? And that's how we get the 65,000. So the net cash flows from lease every period is this negative $195,000. And again, if you calculate the present value of all these lease payments, you get the 702,103 that is given here, right? So now that we've calculated, the present value between the two, we just compare which one is the better option, and obviously, leasing turns out to be the better option. So, if we have this opportunity available to us, we should definitely lease. So, essentially, this chapter is talking about is whether one should decide to lease or to issue debt and own the asset. And basically, what you need to understand is you need to understand how these calculations are made, and you know that's all with this chapter. For certain companies, given the financing terms, sometimes it might be much better to lease rather than to finance through debt. But at the same time, there are certain firms which might, given a low cost of debt, they might prefer to own the asset versus leasing the asset. uh, Again, if you have any questions, please feel free to reach out to me. uh, Thank you.